Okay, so in this module, we're going to do lesson objective 4, which is to understand the items to include as inventory cost. So companies generally account for the product costs, like other assets, so they basically are for the product costs like other assets on like an inventory account type basis. So like kind of like a so companies generally account for the acquisition of inventories like other assets on a cost basis. Product costs are those that attach to the inventory value. As a result, product costs are recorded in the inventory account. Costs are directly accounted with bringing the goods to the buyer's place of business and converting such goods to a saleable condition. So it's going to include acquisition costs of goods, production costs, and freight charges, and labor and production freight charges, and processing the goods and getting them ready for sale. Also, allocating to inventories a share of a buying cost or expenses of a purchasing department. Storage costs and other costs incurred in storing or handling the goods before their sale. Companies usually exclude these items in valuing inventories. They're not really that directly related, so they're allocated, they're not really related to the actual costs. A manufacturing company's costs include direct materials, direct labor, and manufacturing overhead. Manufacturing overhead costs include indirect materials, indirect labor, indirect overhead, and various costs such as depreciation, heat and electricity, insurance costs, and taxation. Period costs are those costs that are indirectly related to the inventory or cost of goods sold. Well, really the acquisition or production of goods. Period costs such as general and administrative and selling expenses are not included as part of the inventory cost. They're excluded from inventoryable items because companies generally consider selling expenses more directly related to the cost of goods sold than to the unsold inventory. They're not really related to the actual inventory. Period costs, especially general and administrative, are so unrelated or indirectly related to the immediate production process that allocation is arbitrary. Interest is another period cost. Companies usually expense interest costs associated with getting the inventories ready for sale. Interest costs are really costs of financing. Interest costs incurred to finance activities with readying inventories for sale are as much a cost of the asset as I guess producing or production, or I guess materials, labor, and overhead. Never mind. Therefore, they reason that companies should capitalize interest costs. FASB rules companies should capitalize interest costs related to internal construction of assets or assets produced as a kind of like a discrete project. A company should exclude. It should not include capitalization for inventories that it repetitively manufactures. The use of a The use of a purchase discounts account in a periodic inventory system indicates that the company is reporting its purchase in an account payable at gross. The company uses this gross method. It reports purchase discounts as a deduction from the purchasing accounts on the income statements. This contrast from accounts receivable. It's kind of the converse. Another approach is to record purchases in accounts payable at an amount that's net. The company records failure to take a purchase discount within the discount period in a purchase discount forfeited or lost, sales forfeited, discount lost. If a company uses the net, it reports purchase discounts loss as an expense of some sort, other expenses and losses similar to shorten over. Better method for two reasons. It provides a correct reporting of the cost of the asset and related liability. It can measure management's inefficiency by holding management responsible for discounts taken. So here we just have the gross method. We have accounts payable, we have purchase discounts, and then we have cash. So basically you're accounting for the entire quantity value, and then you take the actual discount as on a rolling basis. So if you have 4,000, it's within the discount period, then you take 2% of it and get 80, and that means you're only paying $3,920 of cash. In comparison, for the net method, we automatically assume we're going to take the discount, and then we take the discount as is on a rolling basis as well. But then we have to account for the step one where we took the total discount, whereas we're only actually accounting for $80 of it. So we end up with in this account, we have accounts payable, we have purchase discounts lost, and then we have cash. So this is only purchase discounts. This is purchase discounts lost because we assumed that we took the entire thing, that we would take the entire thing, so we view it almost like a loss or expense.